Good evening, everyone. I hope you're all well. I hope you're all doing good. Enjoying the week so far. Sort of coming to the halfway point tomorrow, which is always a good thing. Wednesday is quite a nice day to trade. But more importantly, welcome to the first Technical Tuesday. So this is something I've introduced in the Discord quite recently at the beginning of this week, as I've sort of refined our weekly schedule. And the reason I've introduced the Technical Tuesday sentiment is because it gives me especially a chance to refine some of the things I'm looking at, whether that be a specific technique or the strategy as a whole. But different techniques I want to get down to the T, and sometimes when taking trades it's hard for me to give the correct illustration on my specific bias and the reasoning behind that bias. And how sort of several currency pairs link in, etc. It's sometimes hard to give that explanation in a worded format. So obviously it's better via a video format. So yeah, that's going to be the whole sort of methodology behind Technical Tuesdays. It'll be both sort of like a brief overview if the example is visible on the trade that we took in that week. But more so it is going to be sort of an educational video every Tuesday coming up. So you constantly have educational content provided to you. But just looking at the two pairs, the two major USD pairs we did take a trade on today was Euro USD and USD CAD. So two different biases and two different trade outcomes, but nevertheless, at the end of the day, if it's an L, it's a learning curve. That's the way we look at it, and if it's a win, then we just basically reinvest the profit and compound to further trade ideas, etc. But just looking at what I'm basically want to illustrate, I want to illustrate it's quite an advanced topic, but it's important, and it was present in sort of this example, and it was a reason why I traded Euro USD and USD CAD simultaneously, because in a way I was covered in both entries regardless of the outcome, and I'm going to explain what I mean right now. So the sentiment of this video is going to be hedging currency pairs from two different currency pairs. So we're not hedging the same currency pairs, but we're hedging two different currency pairs. That's basically going to cover us from both angles. So if one trade gets stopped, the other one will run successfully. And vice versa, if the other one gets stopped, the other trade should run successfully. So this is a trade I put on the free Telegram. Euro USD, I had a short bias. And firstly, just explaining my short bias. Again, just to bring up the objective tree. Looking at market structure as a whole. I believe this was talked about on the yesterday video as well, but we had a bullish structure here. We did break market structure, and it looked quite bearish. We had quite a bearish sentiment. We had quite a bearish sentiment on Euro USD again, creating lower lows, lower highs, lower lows, lower highs, lower lows. And arguably, yes, we did take out these prior lower highs here, but we didn't actually take out this high here. So I still felt that downtrend needed to be continued. So it was a matter of getting in on a retracement, and I did state in yesterday's video I will be looking to take short upon a retracement. We witnessed that retracement, and I believe it was this one. Yeah, so I did actually have this trade idea. You can see the time as well, 12:01, that I forgot to actually flag in the group. But yeah, I believe the short was around here, so we would have been in a couple pips of profit. See, so about 30 pips, so we would have got stopped at break even anyways, due to this bullish impulsive move. But the main confluence of this trade here was Wyckoff. This just to show you sort of on a 15-minute time frame, we had this distribution schematic here, and if I actually zoom in into this schematic, what we find is price retraces to quite high levels of premium pricing, but in doing so, we've aimed to fill areas of inefficiency, which we saw present here. We saw a gap in price. In addition to that, we saw this sponsor candle here, the last up candle before that bearish impulsive move, and the top sort of the high of that candle was my sort of invalidation zone. And I felt this candle was mitigated by this wick, and obviously this blind candle, as we call it now, was mitigated by this wick. So I felt this was the last candle that had been unmitigated with. So it's a valid sort of trade to take an entry upon, and we did have that gaps to rebalance with. In saying that, we from a Wyckoff perspective, we did have a 1 minute distribution schematic. But in saying that, we normally do have continuous amount of last point of supplies, which we may actually be forming as we're talking right now. But I feel my whole bias on Euro USD has changed, and the reasoning for that is, firstly, we do have these engineered highs on the hourly time frame. So again, yes, these do need to be swept, but I feel a more deeper retracement needs to come into one of these sponsor candles, or arguably just to rebalance with price. We've seen quite a bullish impulsive structure creating a lot of inefficiency. And I did think a retracement was due in order to go higher. But my whole initial target wasn't just a retracement; it was more so to sweep out this sell side liquidity. Yes, we did have a pip or two sweep, but this wasn't really a stop loss hunt as such. It was more an order activation. So people who had buy stops present below this low, etc. Sell stops present below this low, etc. As they thought the market sort of in a bearish sort of trend. Them sell stops have been activated, and the stop losses will be present above that sort of candle maybe, or they probably retail traders probably put their stop losses 20 to 30 pips above that sort of level. So yeah, as you can see, we have had an impulsive run there, and the reasoning is to engage with all retail stop losses. But that's for a whole other topic in itself. The main sort of reason how we covered ourselves, not necessarily the public as such, but how we covered ourselves in Euro USD was by taking the USD CAD trade as well. Now the USD CAD moves in sync with the dollar, and Euro USD moves opposite to the dollar. So what we're doing is we're hedging our coin on both biases. So if we've got a an overall bullish bias on the dollar, so if I just show you what I was seeing on the dollar, just to quickly give you a recap on my sort of yesterday's market analogy on the dollar. I feel that the bias still remains the same. This gap definitely needs to be filled in soon. I feel we will get a sweep of this low here. But yeah, my bias was bullish on the dollar, and then ultimately have that sell off. But I did expect a small sort of pullback for then to see bullish pricing. But what we're doing is we're shorting a currency pair that's related, that moves positively with the dollar. So example would be USD CAD, as we saw straight from the limit. We did have, like, I believe it was 4 pip drawdown. So yeah, 5 pip drawdown. And ever since then we've been straight into profit. Now this moves in sync with the dollar. So we've got one pair that's moving in sync with the dollar, and we've got one pair that's moving against the dollar. So we know one of these trades are going to go right. Either the dollar is going to go bullish or bearish. Arguably it could consolidate, but we had a strict bias in mind. So when the sort of market's uncertain, and as mentioned in the previous sort of market outlook, I did mention that yes, I did want to see higher prices on the dollar, but I did want to see that small pullback first. And this is in these indecisive sort of market environments. That's when you want to be hedging the coin. That's when you want to be hedging the bet, in the sense that regardless of what the dollar does, we've sort of caught onto a substantial move. Sorry about that, my mic cut out. But as mentioned previously, Euro USD moves against the dollar, and USD CAD moves in sync with the dollar. And both of our biases were short. Now, in a sort of perfect world or a normal scenario, my bias on Euro USD and if I was trading USD CAD simultaneously, would be two opposite biases. I would be long on Euro USD and short on USD CAD. But instead, we were short on both currency pairs, and this brings a question on why. Why would you short both currency pairs when one moves against the dollar and the other moves in favor of the dollar? And the reasoning is because yesterday in the market outlook, I did explain there wasn't an uncertainty to the dollar, but I did want to see some things comprehend before I sort of stuck to a solid bias. So my initial bias was to see a bullish reaction to fill in this sort of gap here and to come to this sponsor candle, which I believe was on the sort of 4-hour area of interest. So if you haven't seen that video yet, do go and sort of watch that video. But I did explain in the video that I wanted to see a small pullback before we have that next bullish leg up. We did witness that pullback, but by no means it wasn't small. And what I was basically targeting was, if I go into the sort of 15-minute time frame on the dollar, or it was the 30-minute time frame, we had this sponsor candle here. So yeah, I was hoping for a bullish reaction of this sponsor candle, as this previous sort of price action had been mitigated with, as we had wick to wick to wick, sort of a last down candle before the up move that had been mitigated with that wick, and this was the last candle that hadn't really been mitigated with yet. But price is sunk straight through it. Now what we could sort of look for dollar to do next is to sort of react upon this level as a institutional candle. So we have a sort of support and resistance type scenario, but it's nothing like support and resistance. But as soon as we break through a sponsor candle, it sort of turns into a institutional candle, and then we may look for lower prices on the dollar. But overall, my bias is still long. I would favor, highly favor this gap to be filled and sort of this sponsor candle to be mitigated with. And as mentioned previously, I would like to see a sort of reaction like this. But scaling back onto our sort of bias on hedging two different currency pairs, by shorting a currency pair that goes against the dollar and a currency pair that moves in sync with the dollar, we are going to catch one of the trades. And this was a perfect example to do it, because of the fact that I did want to see a pullback, but then I did feel there was a bullish reaction on the dollar. So in saying that, if we had seen the bullish reaction, we would have caught the sell-off on Euro USD. Yeah, we would have caught the sell-off on Euro USD, and while the sell-off was happening, USD CAD would have basically hit our initial target. And the reason I say initial target was someone did mention, oh, the USD CAD was not. Someone in the Discord did mention the USD CAD trade was nice. Yes, and then I sort of alerted take 70% of profit here. Now, the reason I said take 70% of profit here is because if we had hedged our position on Euro USD short, this would have meant USD CAD would have had a retracement sort of to the bullish side. Ideally to the sponsor candle, or to create a new lower high, ideally to create a new lower low, or we could have reacted off this institutional candle here. So I believe it was around this level here. I said take 70% of your profit here, so we could have reacted upon this level here and then seen bullish prices. So it was a hedge trade on two different currency pairs, but done in a way that wouldn't make sense to the average eye. So we're hedging according to what this sort of dollar is doing, and yeah, whatever it presents, we're able to capitalize on. So we did in a way lose out on Euro USD, got stopped by 5 pips, but we had a beautiful trade on USD CAD. I'm sort of happy with that. Close 70% on my position. If the rest 30% hits take profit, it hits take profit. If not, my stops are going to remain at break even. I may trail it down to this sort of high here, but in saying that, this is all inefficient pricing now. We could come back to this sort of sponsor candle here, have a reaction into that, and then see arguably lower prices. But as we're forming these lower highs, sometimes it even affects with your psychology, etc. So it's better, you take profit off the table and you look forward to the next day. Tomorrow's a whole new day. But in saying that, it was a beautiful thing because I personally like to trade with time. So this meaning in the London session, in the New York session, etc. So yeah, that's my prime time to do it. And I believe we took this in the New York session. So yeah, coming close towards the New York close. And this was basically took arguably in the middle of nowhere. But it was worth a sort of it was worth the risk in the sense that if this had sort of pulled through, that's a 1 to 22 risk to reward, and sort of all these sort of things you'd want to look for a trade. For example, if I just scale into a 5-minute time frame and we just see that sort of distribution schematic again. So it's originally a 1-minute distribution schematic, but you can see it on a 5-minute as well. I'll just zoom in quick. So yeah, we had this distribution schematic, but inside we had that sort of inefficient pricing, and we had that last sponsor candle. So that was a good confluence and an area of interest of mine. It did look good. Unfortunately, that didn't pay through, but again, we were hedging against the dollar, if that makes sense. So yeah, that's a good thing to sort of keep in mind. Try and backtest this. So if you're in the middle of backtesting, you're not really sure what the dollar's going to do. Have that sort of bias in shorting both a currency pair that moves against the dollar and a currency pair that moves in sync with the dollar. And currency pairs that move normally in sync with the dollar start with USD, and then it will have the other currency pair at the end. For example, USD JPY, USD CHF, USD CAD. So it's just USD XXX, and currency pairs that normally move against the dollar are normally XXX USD. So for example, Euro USD, GBP USD. The list goes on, but it's normally XXX USD that moves against with the dollar, and that moves in sync with the dollar is USD XXX. But yeah, that's our first Technical Tuesday. It's a bit of a sort of advanced topic, hedging against the dollar with two different currency pairs. I will talk about my standard sort of hedging, but the market right now, the market environment, by no means is not sort of a market to sort of hedge with. Due to the sort of choppiness and the contraction ranges we've been in. But yeah, I'll be doing a topic or a Technical Tuesday just strictly about hedging. But yeah, take this sort of information in. If you do have any questions, let me know. And yeah, I hope all of you have a good night.